Have you ever wondered how to trade range breakouts better? Too often, price keeps on fluctuating after breaking a support or resistance level, and then it might even stop you out before really taking off. So what can be done? In this video, I'm going to show you a better way to get into potential breakout trades, and this method will give you a better risk to reward ratio also. If you haven't done so already, go to TIOmarkets.com/contact and ask for more information on VIP Black account. You get 0 commissions per lot, no monthly subscription fees, and you get also very tight spreads. It's a great trading environment. I can really recommend this to you. You should watch this video only if you agree with this disclaimer and with the fact that we don't provide any investment advice. And also, while there is no best trading strategy, just like there is no best car or a best tool, there can be a strategy that is best for you. I have put this video series together so that you can find the best trading strategy that works the best for you. As you can see from this chart, gold has this tendency to go into these sideways movements and then break out. So the question is, how should we trade these? Obviously, there's the old-fashioned way of using breakout trades when the market breaks out of this range. But in this video, you're going to learn how to actually get something a little bit better, a better entry. And I'm going to show you a systemized way of entering into these volatility explosions or anticipating these before they happen and then taking advantage of those who are buying after the breakout happens. Here we have gold in 30-minute time frame, and as you can see, I have drawn a couple of resistances, support and resistance levels here. And basically this is to highlight the difficulties or the challenges we have with the traditional breakout trading. So obviously the old way of doing this is to choose a support or resistance level and trade when the market moves beyond those levels. The problem here is that which level we choose. Why is this more relevant than, say, for this one? Or why is this more relevant than this? Or why should we choose any one of these? Why not to go for this one? Therefore, there must be a better way. There must be other ways to engage in markets that are ranging, and looking for moving average setups is one of the ways. Here we have 7, 15 and 30 period moving averages. As you can see, the red one is the fastest, the blue is slowest, and the green is the 15 period in the middle. And the idea with this setup is that as we have the moving averages lining up and the price trading above the moving averages, then we can prepare ourselves to look for a long trade. And when I talk about lining up, I mean that we have the red above the green above the blue. And this approach engages with the market when we move between the moving averages, close to where the 15 period is, the green one. So here we have the price trading between the red and the blue and around the 15 period moving average, which is the green one. And then that's the area or the time to take a long trade, and then the market moves higher. It actually moves quite a bit before it starts to lose momentum. And while we never can, or sometimes you can, but usually we can't catch the tops, let's assume that this signal initiated, the trade was initiated somewhere here, and we catched most of the move. That would be, even if we missed that bit there, that would be almost $16 move, 0.89%, which is a significant move in gold. But is this the only occasion this works? No. As you saw earlier, we have several ranges, and we're going to go and look at one or two other examples also. Okay, this is late August, early September 2021. And again, you can see how the price of gold is ranging and moving sideways. And we have this same problem here. If we are thinking of the traditional way of breakout trading, what level do we choose? Do we go for this one or for this one? Or on the downside, this or this? So how do we decide what's a relevant level? And again, I'm proposing a moving average setup here. That the very same setup which I saw working nicely in the previous example. So here we have the price trading above the moving averages, and the moving averages are about to line up correctly. A little bit more data, and we have the red above the green and the green above the blue. So here we go, and the price retraces lower, comes to the 15-period moving average, and this is where we engage in this market. The price rallies higher, but then starts to lose momentum a bit and retraces down. So maybe at this stage our trade is in the red, but we have the stops in place, so we're not worried. We don't risk too much. We only risk something that is in accordance with our long-term trading plan, and we never take big risks, so that's not a problem then. And then the price starts to find support from the 30-period moving average. It moves above it and finally makes a move higher. So now it's looking really nice, and here's one of those occasions where a breakout trading with traditional way would have been quite challenging, because you might have gone long here on the break of this high, but then the price retraced down quite a bit, something like over $3. So anyone who entered long there then had to suffer some drawdown before the market was moving again. But those that bought here using this moving average setup actually had a long trade, and then the price really took off. So again, a pretty massive move in gold before gold started to lose momentum there. And by the way, this is a 30-minute chart, just in case you wonder. This, from these lows here, if we even manage to get one, say most of this move, that would be 1%, $18.50 move. So a very, very significant and a nice move there. And here we have a short trade example, again in 30-minute time frame, and we have the same moving averages 7, 15 and 30. As you can see, we have multiple levels here too, but now in this case the market moves lower. We have the market moving below the moving averages, and eventually the moving averages are lining up, so that we have the red is the weakest, or the quickest moving average is now the weakest. It's pointing down, it's below the green, and the green is below the blue. Okay, here some people take a short trade on the close of this candle because we have a break below this support. So that means the entry is around 1768, 77. So that can be okay, but the moves against the trader can be quite significant. Here we have the market moving from 1768, almost $10 to 1775. If we use the moving averages as an entry, especially this green one here, then we can reduce that to about $4. 1772, spot 78, and then the biggest move against us is to 1776.14, so less than $4. And then the market starts to move, and it moves quite significantly again about $15 to $20 move compared to the risk of $4. So that's, we never get all of the move, but about $17 wouldn't be bad compared to a risk of about $3.2. In this video, we've talked about gold, but actually this strategy idea works in other markets too. Here we have Qualcomm stock ranging sideways until the moving averages start to line up, just as we have seen in those gold examples. And then the price retraces lower, we get our signal to go long and see what happens after this. The market fluctuates a little, but then there's a sizable rally, which actually later on leads to even higher prices. And here's another example where GM stock is range bound after a drop lower. Then this triple SMA setup provided a great entry point to a multi-dollar rally. The moving averages line up and we get our buy signal. See again what happens after this. The market moves sideways a little bit, but in about 2 days, the market has rallied over 7%. Pretty powerful, isn't it? Thank you for your time. It was really great to have you here. If you have any questions about trading in general or about this video, please email me on support@TIOmarkets.com. Thank you once again and trade safe.